Hello and welcome to the lecture for Unit 7 on pensions and other post-employment benefits. We'll begin the lecture by spending some time talking about pensions and OPEB as it's called, and some of the basics of how pensions and OPEB are accounted for and reported under the new standards, the new pension standards, GASB statements 67 and 68, which governments have already implemented, and the OPEB standards, statements 74 and 75, which governments will begin to implement in about a year and a half or so. The presentation will be, basically addressing both pensions and OPEB as I talk about what the standards require and how they work. But I should note up front that the assignment you have involves a government that, because we're still a couple of years away from the implementation date, is still following the old OPEB standards. So I will very briefly talk about the old OPEB standards and how they're different so that you'll be able to look at that financial report and make heads or tails of what they're reporting under the old standards. And then there'll be sprinkled throughout this a discussion of, understanding and analyzing the information that you see reported about pensions and OPEB. But I will bring that all together in the last part of the lecture and, point to the main analytical approaches, the main ratios that are used for pensions and OPEB. I mean, one of the interesting things I think about financial reporting for pensions and OPEB is that they require the reporting of the basic ratios that are used for analyzing the affordability, the funded status, and other issues related to pensions and OPEB. So as you know, people who work for governments are generally compensated in two ways. They receive current and deferred compensation, and the current compensation is the pay that they receive on a biweekly or monthly basis, and also fringe benefits they get like health insurance coverage for themselves and possibly their families, paid sick leave, and so on. But a significant part of compensation for many government employees is a deferred form of compensation that they are earning as they work throughout their careers, but which they won't receive until after they leave the employment of the government, generally by retirement when they reach their retirement age. Some of that is pensions, so that's an income stream being provided to help support retirees after they have stopped working. And the rest, everything other than pensions, is other post-employment benefits or OPEB. And mostly what we're talking about here is retiree health insurance. That certainly represents the overwhelming majority of the dollar value of those benefits, but it may include other benefits that are besides retiree health insurance that aren't provided through a pension, maybe death benefits or life insurance or legal services, as long as those things are not provided through a pension plan. Pensions in general are financed by putting money aside in an irrevocable trust. That money is then invested, and the earnings on those investments help to pay for the benefits when they come due in the future. This is called pre-funding. Governments are putting money aside in the trust on an annual basis. That money is invested, it earns more income, and that helps to pay for the benefits, makes it more affordable for the government to pay for those benefits and to ensure that there are sufficient resources available in the future when those benefit payments have to be made to the retired employees. On the other hand, even though there is a little bit of pre-funding for OPEB, overwhelmingly governments pay for OPEB on a pay-as-you-go basis, essentially either paying premiums to an insurance company on behalf of the retirees, or if they're self-insuring, making direct benefit payments to the employees to reimburse them for covered medical expenses. But in general, governments don't set money aside in advance for OPEB. And that has an impact on the way the benefits are reported and the information that you're likely to see. In addition to contributions from the government and earnings on the investments of the trust, if there is a trust that contains accumulated assets, there are almost always going to be contributions from the employees as well, and occasionally contributions from other entities, often other governments, that are legally responsible in some way for some or all of the cost of those benefits. For instance, there are a number of states that pay for some or all of the pension benefits of teachers in local government, in local school districts. There may be some federal reimbursement for certain pensions for certain types of employees. So you're getting contributions from the employer, from the employees themselves, and sometimes from non-employer contributing entities, as they're referred to in the standards, and then all of those contributions are invested, and they in turn earn investment returns, all of which is available then to make benefit payments as they come due. In general, there are two types of post-employment plans: defined contribution and defined benefit. Defined contribution plan, as it's defined in the accounting standards, is one that stipulates the amount that the employer is going to contribute to the plan. The contributions are made to accounts for each individual employee, and the benefits that the employee receives ultimately will depend only on how much is contributed and how much those contributions earn when invested. So the government is not on the hook for a specific benefit, just to contribute a certain amount each year, and then basically all the risk is on the employee, in terms of what they will ultimately get based upon how that money is invested, and in some cases the employees have control over how that's allocated, what types of investments, similar to a 401k. On the other hand, and this is the type of plan we're going to be talking about, for the rest of the lecture, defined benefit plans are all the plans that don't meet the definition of a defined contribution plan, don't exhibit all three of those criteria. But what we're essentially talking about here is a plan where the employer has promised a certain amount of benefit to be received in the future, and this is when you see pre-funding, where they try to put aside enough money in order to ensure that there will be sufficient money in the plan when the benefit payments come due, based upon assumptions about how long people are going to work, how long they're going to live, how much they're going to earn while they're working, and so on. This is the type of plan for which governments have a liability. And when you hear people talking about pension liabilities and OPEB liabilities, they're talking about those related to defined benefit plans, the value of the promise the government has made to its employees to provide them a certain amount of benefit in the future. You will also see that defined benefit plans, are distinguished based upon how many governments participate in the plan. A single employer plan obviously includes just one governmental reporting entity, one city or one state, for instance, whereas multiple employer plans include two or more governmental reporting entities, and in fact, usually dozens or even hundreds, or well over 1,000 for some larger governments with cost-sharing plans, multiple employer cost-sharing plans. A lot of governments will participate. And those multiple employer plans are of two types. The agent plans are essentially like an aggregation of a whole bunch of single employer plans, because the money related to each government is kept separate in separate accounts from the other government. So there's no, they may mix the money for the purposes of investment, but they keep track of how much belongs to each participating government, so that the money for each participating government is only being used to pay benefits for that government's retirees. So it really is like a whole bunch of single employer plans under one administrative umbrella, and they save money by sharing the administrative costs and by getting the greater investing power of combining all of their money together. On the other hand, cost-sharing multiple employer plans are those in which all of the money is commingled, that is contributed from the various governments, not just for investing purposes, but the benefits for all of the participating governments' retirees are paid out of that same common pot of money. They're sharing the risk across governments. So let's turn now and look at what the new pension and OPEB standards require governments to do in terms of measuring the obligation and cost of their benefits and what they're required to report in their audited financial statements, notes, and supporting information. It's important to note the way that the board, the GASB members, looked at pensions and OPEB traditionally. This is a deferred form of compensation that the retirees won't receive until the future, but it's something they earn while they're employees, while they're working, which argues that there is an obligation, there's a liability that needs to be recognized long before they are actually retired and ready to receive those benefits. And the cost of those benefits should be accrued and recognized as they're being earned in each year that the employees are working, and not in the future when the actual cash payments to the retirees are made. You should also know that the board doesn't look at this transaction between the employer and employee as a discrete new transaction each year, but looks at it as a transaction that lasts over the period of service, the career of the employee for that government. Public employees tend to work for their governments for much longer than people work for private companies. And even when they leave a particular government, they tend to go work for another government, often one that is in the same multiple employer pension plan as the government that they left. And so they're not really switching to a new pension plan. They're still in the same pension plan. And that has an effect on the way certain aspects of the cost of pension benefits are recognized. Under defined benefit pension and OPEB, there are two possible liabilities a government may have. One is a liability to the plan in the form of a payable. If a contribution was required to be made on a certain date and it hasn't yet been made, you will still accrue that cost for that payment that should have been made, and there is a liability then, a payable to the plan. But the big pension liability or OPEB liability that most people are talking about when they talk about the gigantic size of the pension problem or OPEB problem that governments are facing is the liability to the employees for the benefits that they have been promised. So you know that the new standards require governments to report that liability for those benefits for the first time on the face of the financial statements. Previously, they were required to calculate it and disclose it in the notes, but not to report it on the face of the financial statement. So that's a pretty significant change. For some governments, this liability is extraordinarily large. For many governments, much larger than the amount of outstanding debt they have. So this is their really big long-term liability, which up to this point they haven't been showing on the face of the financial statements. Now they're going to put it on the face of the financial statements and likely have a pretty significant impact on their unrestricted net position. The liability that they are reporting is based upon a calculation of the total liability using actuarial methods that project benefit payments to the future based on the terms of the plan. And this phrase that is in the first bullet I won't read verbatim because it won't make sense until a couple more slides when we talk about the process of measuring the liability. But you begin with the total amount that is owed, and then depending upon whether a government is financing the benefits through a trust that meets the criteria that are established in the standards, meaning that the contributions are irrevocable and that they're protected from creditors, and that they're dedicated just to providing benefits to the members of the plan, If there are assets that are in a trust like that, then those are subtracted from the total liability, and you get the net liability, either the net pension liability, or NPL, or the net OPEB liability, or NOL, and that is what is recognized on the face of the financial statements. If they don't have a trust, which is the case for most governments when it comes to OPEB, then they're going to recognize the total liability because there are no assets to subtract from it. The liability that they're reporting should be measured no earlier than the end of the prior fiscal year. So if they're implementing for June 30th, 2015, which governments with June 30th fiscal year ends, that was their effective date. Most of them used a measurement date 1 year prior. They used the full offset of June 30th, 2014. That still is 2015's liability. And one thing you may see as you look at CAFRs is that a lot of governments are labeling it as 2014 because that's when they measured. That was the date as of which it was measured, but it actually is the amount of the liability that's reported in the financial statements for June 30th, 2015. So it is 2015's liability. The reason the board gave that offset was because, really for practical reasons, to make it easier for governments to implement and to make it easier for them to coordinate with their pension plan, which, especially in the case of multiple employer pension plans, may have a different fiscal year end. And so they needed to be able to provide a sufficient cushion to be able to get the information, because in a lot of cases, employer governments are going to be getting that information from the plan. The measurement of the liability should be based on an actuarial valuation, either as of the same date as the measurement date or as of a date no earlier than 30 months and a day prior to the fiscal year end. It tends to be much sooner than that because actuarial valuations need to be done at least every 2 years, and frankly, for the large plans, they all do them every year. So chances are that actuarial valuation is not long before the measurement date of the liability. If there are significant things that have occurred in between the actuarial valuation date and the measurement date that have an effect on the size of the liability, then governments don't necessarily have to do a new actuarial valuation, but they may have to perform what are called updating or roll forward procedures in order to capture the impact of those changes, so that the measurement as of the measurement date is the freshest and most up-to-date measure of the size of the liability. The value of the assets in the plan, in the trust, have to be measured as of the same date as the measurement of the liability on that measurement date. And that value of the fiduciary net position, the assets in the plan less any liabilities that the plan has, is subtracted from the total liability, and that is the net pension liability or net OPEB liability that is reported on the face of the financial statements. Now, the way that the actuarial measurement of the liability works is extraordinarily complicated, and I'm not going to get into the detail of it. It's not necessary for this class. But suffice it to say, in very simple terms, that what is done is, based upon the terms of the plan and the specific benefits that are provided and how those benefits are calculated, the actuary will project the cash flows for benefit payments for every year going forward until the very last member of the plan or member's beneficiary has passed away and is no longer receiving benefits. So it often is 75, 80, 90 years out into the future. And then each of those projected benefit payments is discounted to their value today, their actuarial present value. And then that actuarial present value is allocated between past periods of service and future periods of service. And it's that portion that's allocated to past periods of service, that's the total liability. That's the total amount that is owed as of the date of the financial statements for those benefits. So if you want to look at this graphically, looking at a particular employee who starts to work at age 25, and now the date when they're measuring the liability this person has been working for 15 years, they're now 40. So the projections that are going to be done are going to take into account assumptions about how old the employee will be when he or she retires and therefore begins to collect benefits, as well as, and that's, the service period, the full number of years over which they have worked and earned benefits. And then there will be an assumption also about how long they're going to live and therefore how long they're going to continue to collect benefits over their benefit period. And so each of the amounts that is projected then for benefit payments between age 62 when they retire and age 80 when they pass away and stop collecting benefits, each of those projected benefit payments is discounted back to the current day, to this period right here when they're 40 years old. And then you add up all of those present values to get the total present value, total actuarial present value, and a portion of it is allocated to past periods and a portion to future periods, and it's this portion allocated to past periods again. That's the total liability that serves as the basis for what is reported in the financial statements. Either if no trust, no assets set aside, then a government will recognize the total liability, or they'll recognize the total liability minus the fiduciary net position of the plan if there are assets accumulated to pay those benefits. So the projections, in addition to assuming how long somebody's going to work and how long they're going to live, it's going to make assumptions about how much they're going to earn, because that tends to be a part of the calculation of the pension liability, and then other factors as well to the extent that they're relevant to calculating how much somebody's going to earn in the future. Service credits is referring to the number of years that they work usually, if there are cost of living adjustments in there. For OPEB, if they're going to make assumptions about how fast the cost of health care is going to rise. If there are any taxes or other assessments that are imposed on benefit payments, such as the Cadillac tax, that's a part of the Affordable Care Act, that also needs to be included in there because that's a part of the cost of providing those benefits. And for OPEB as well, they're also going to look at what the historical practice has been in terms of how the employer and employee shares the costs of those benefits, and they're going to then extend that pattern out into the future to determine what part of the cost of the benefits is going to be borne by the government as opposed to borne by the employees. For this actually just says OPEB, but it applies to pensions as well. The discount rate that is used to discount those projected benefit payments to their actuarial present value is a single rate that reflects the long-term expected rate of return on plan investments, as long as it is projected that there will be sufficient assets in the plan to make those payments. And if not, they will discount using a municipal bond rate, specifically one for a 20-year tax-exempt general obligation bond rated AA or its equivalent or higher. Now, the way they will figure out which of those rates they're going to apply to which years will require a government to, in addition to projecting what the benefit payments are going to be in every year going forward, they're going to project how much the fiduciary net position of the plan will be, and compare those two numbers, and as long as the amount of fiduciary net position exceeds the benefit payments, they will discount those benefit payments using the long-term expected rate of return, which for most governments these days tends to be 7 to 7.5%, whereas the rate for a municipal bond of this type right now is probably in the range of 3% or less. As you know, mathematically, the smaller the discount rate you use, the larger the present value that you obtain. And if the present value is larger, that means the amount of the liability that's being reported is larger. And I'll show you graphically how this works. So here's a chart that shows, government is projecting their benefit payments going out all the way into the future. There's a gap here between year 30 and year 95, but they've projected all the way out until there's, absolutely no benefit payments being made. And they will project also the amount of plan net position and compare this number with this number. And as long as the number in B is larger than the number in C, they will discount using the long-term expected rate of return. So you see that they're projecting out into the future. And up until this point, year 25, the projected plan net position is greater than the projected benefit payments. So each of these projected benefit payments is discounted to its present value using the long-term expected rate of return, which in this example is 7.5%. But after that period, in year 26, you hit what is referred to as the crossover point. So that's the point at which the plan net position is no longer larger than the amount of benefit payments. And so from that point forward, the projected benefit payments are going to be discounted using the municipal bond rate. And in this example, it's 4%, although I think that's probably a little bit high. And the reason why that previous slide referred to a single discount rate is because what governments will do is they'll add up all the present values discounted using the long-term rate of return and all those discounted using the municipal bond rate, add them together to get, so here's the total actuarial present value in this example, and then they will mathematically back into what one rate, if it had been applied to every year, would produce the same actuarial present value. And in this case, it's 5.35%. And it's important to know that because there's a new note disclosure that shows the sensitivity of the measurement of the liability based upon the selection of the discount rate, and it's going to be varying around that single discount rate that is calculated for a government that's using both a long-term expected rate of return and a municipal bond rate for separate years. Now, for a lot of governments, based upon how well they're funded or what their contribution policy is, they may never hit a crossover point, so they will only discount using the long-term expected rate of return. Other governments that don't have any money, they don't have a trust, and this is going to be the case for most OPEB plans, all of their discounting will use the municipal bond rate because there is never any fiduciary net position in the plan to make those projected benefit payments. It's all being paid on a pay-as-you-go basis. So just to give you an example of the impact of the assumption about the discount rate, let's assume there are two governments that are the same in all relevant respects, except one is fully funding its plan. It has no crossover point, so it's always going to discount using the long-term expected rate of return. And the other plan is on a pay-as-you-go basis, and so it's going to be doing all the discounting using a municipal bond rate. So let's assume that's 3% and the long-term expected rate of return is 8%. So here's the present value of a stream of benefit payments going out into the future discounted at 3%. So in year 10, it's about 7.5. This is all in millions, so about 7.5 million. Going all the way down to approximately 3 million is the present value of the benefit payments in year 39. Now look at what the benefit payments would look like if discounted at 8%. You can see, obviously, they're a lot less than when discounted at 3%. And just pick one year here. In year 23, the present value for at 3% is about 5 million, and it's only about 1.6 million for when it's discounted at 8%. So the lower that discount rate, the much bigger the liability is going to be. And if you add up all of those individual years' present values, you see that at 3% it was 150 million, and at 8% it's a little bit more than 1/3 of that, just 56 million. Now, once the discounting has been completed to the actuarial present value, that amount is then allocated using a cost allocation method to past periods and future periods. It used to be that governments could use one of 6 different methods that could be applied in one of 2 different ways. The new standards remove all of that variability. So every government will use what is called entry age, applied as a level percentage of pay. And to the extent that there was some undermining of the comparability of pension and OPEB measurements in the past as a result of that. That should go away because all governments are now using exactly the same method. For the OPEB standards, under the old standards and under the new standards, for very small plans, those with fewer than 100 members, active and inactive combined, they can use this thing called the alternative measurement method, which is a somewhat simplified approach that a government could use instead of having a full-blown actuarial valuation. It's provided for cost-benefit purposes, and is really only available to very, very small plans in order to make it more affordable for them to apply these standards, and that continues going forward. But you're not likely to encounter that very often. There aren't many plans that meet this this threshold of fewer than 100 members, and even fewer that are producing annual audited financial statements based on generally accepted accounting principles. If you're a government in a cost-sharing plan, your actuarial valuation is done for the plan as a whole. In the case of single employer plans and agent employer plans, each individual employer has a separate actuarial valuation because they're all separate plans. Even in an agent multiple employer plan, remember, as I said, that there's a really like single employer plans bundled under a single administrative umbrella. So they're doing actuarial calculations for each separate participating government in that plan. But for cost-sharing employers, in a cost-sharing plan, the actuarial valuation is done for all of the participating governments in the plan combined. So in order for a government in a cost-sharing plan to report their information in their financial statements, they have to determine what their proportion is of the liability that is measured for the entire plan, as well as their portion of the expense of the entire plan and their portion of the deferred outflows and deferred inflows of resources related to pensions and OPEB for the plan as a whole. So those governments will first determine what their proportion is, their percentage, based in some way on a comparison of their contributions to the plan relative to all of the contributions to the plan. And governments are encouraged in the standards to base this on a long-term period, not to just do it on a single year, but they're allowed to do it that way. And I think in most cases that's the way governments and cost-sharing plans have done it, that they've looked at essentially last year's proportion. And the reason that the standards encourage a longer-term view is because it's much less likely that that proportion will change from year to year if you're looking at it over the long term. Whereas if you're looking at it just from year to year, it's a much greater chance that there will be a change in the proportion, and that requires some form of adjustment and measurement to capture that change in proportion. So once they know what their percentage or proportion is, they will then take the collective net pension or net OPEB liability for the entire plan, multiply it by their percentage, and that's how much that employer is going to report as their liability, their expense, and their deferrals in their own financial statements. It used to be the case under the old standards that governments in cost-sharing pension and OPEB plans reported much, much less information about their plans than governments in single and agent plans. And although there are still some things that single and agent employers report under the new standards that cost-sharing employers don't, most of that difference has gone away, and everybody has to do the recognition of the liability and the recognition of the expense. And most of the note disclosures and supporting schedules are exactly the same. And in cases where there's something that agent and single employers provide that cost-sharing employers don't, cost-sharing employers are required to report something else that tries to address the same issue. Now, the basis for pension and OPEB expense is the annual change in the net pension liability or net OPEB liability. And most of the components of the change in that liability are reported immediately as pension expense or OPEB expense in the year that they occur. Normal cost, for instance, which is the value of the assets, the value of the benefits that are newly earned in that year, that's reported in pension and OPEB expense immediately. interest on the total liability, and the effect of changes in benefits. So if there's an improvement in benefit terms that increases the size of the liability, that entire increase is recognized immediately as pension or OPEB expense. But there are a few things that are recognized over multiple years in pension expense. Two of these are changes in economic and demographic assumptions that go into the projection of benefit payments, and differences between those assumptions and what actually occurred, which is referred to as experience gains and experience losses. Those two items, to the extent that they cause a change in the liability, that part of the change is initially recognized as either a deferred inflow or a deferred outflow. A deferred inflow if it reduces the liability, a deferred outflow if it increases the liability. And then that is introduced systematically and rationally into pension or OPEB expense over the average remaining service period of all members of the plan, both active and retired. And so that's a relatively short period for most governments. My observation has been somewhere between 5 and 10 years is what most governments have found is the average remaining service period for all the members of their plan. To the extent that the difference between what was assumed for investment earnings for the plan and what actually occurred in a given year causes the liability to increase or decrease, that amount also will initially be reported as a deferral and then introduced into pension expense systematically and rationally over a 5-year closed period. So there are 3 items that are introduced into pension or OPEB expense over several years rather than immediately. If a government makes contributions to the plan after the measurement date, and given that so many governments are using that full 1-year offset, basically every contribution they make during the fiscal year is after the measurement date, because you've already measured the liability, a contribution to the plan would reduce the liability, but you've already measured it. So what you do in that year is you report it as a deferred outflow of resources, and then it reduces the liability in the following year. And then lastly, for governments that are in cost-sharing plans and they have to make those assumptions about what their proportion is, there may also be some adjustments they need to make related to differences between the assumed and actual proportion that they had for the year and changes in the amount of their proportion. The effect of those on the liability in any given year are also reported initially as deferrals and introduced into pension or OPEB expense over the average remaining service period of the employees, of all the members of the plan, both current employees and former employees.